If we look at a typical pension plan, balanced funds and target date funds are options there. But what are they and what is the difference between the two? Is one better than the other? Let's delve in.
You probably heard about the 60-40 portfolio funds before. These are balanced funds. A typical balanced fund invests in a static mix of 60% stocks and 40% bonds. But this need not be so. There are many other balanced funds whose allocation to stocks varies from 50% to 70%. Let's take a look at the oldest balanced fund called the Wellington Fund, owned by Vanguard. It has been around since 1929. Wellington invests about 65% in stocks and 35% in bonds with a broad reach into many sectors. Looking at Wellington's portfolio, we see a very small allocation to foreign stocks, which is around 5%. Also note how this fund invests in individual securities, but not other funds.
If we look around, there are many balanced funds that focus on US securities. Morningstar classifies them as US fund moderate allocation category. The typical allocation to foreign stocks for these funds is around 10%. But there are other balanced funds with high exposure to foreign securities. These are so-called global balanced funds. Their typical allocation to foreign stocks, for instance, is around 25%. Next is target date funds. They are mutual funds with changing allocations between stocks and bonds. I made a video where I go over these funds, their pros and cons in great detail that I'll link here. But here's what to know about them.
They have a target date, which corresponds to the planned retirement time. Here's the so-called glide path that shows target date funds allocations. A typical target date fund starts with a very high allocation to stocks. Usually it's around 90%. The rest is in bonds. After 20 years, it will start gradually shifting assets into bonds. When the target date arrives, it will typically hold 70% in bonds and 30% in stocks. One thing to note about target date funds is that they invest in foreign stocks and foreign bonds. What's more, the allocation to foreign securities could be quite large. For instance, the Vanguard 2070 Target Date Fund has 35% allocation to foreign stocks. Similarly, it invested a third of its bond allocation into foreign bonds. Also notice how target date funds typically do not invest in individual securities. Instead, they are funds of funds, meaning they buy other mutual funds. Usually these funds are of the same fund family, such as Vanguard.
Here's a quick summary of what we have just covered so far. Of course, these are comparisons for an average fund in each category, and we can always find exceptions to these generalizations. Now, let's further contrast these two types of funds.
The first point of comparison between balanced and target date funds is fees. Target date funds used to be expensive, but not any longer. The average fee range for target date funds is 0.5 to 0.6% compared to 0.7 to 0.8% for balanced funds, according to Morningstar. As we saw, target date funds hold funds from the same financial institution. This can significantly reduce their fees. Also, their turnover is incredibly low. Sometimes it could be as low as 2%. Conversely, balanced funds typically hold individual securities with higher turnover ratios. This leads to slightly higher fees compared to target date funds. So the win here is target date funds. Though I must say that it also depends on the fund family. For instance, Vanguard target date funds command 0.08% fee. At the same time, Vanguard Balanced Index Fund has a 0.06% expense ratio. So it all depends on what you're looking at.
Next is performance comparison. Unfortunately, it's not that easy to compare balanced funds with target date funds for several reasons. First, it's not clear which target date we should choose. And second, there are different types of balanced funds.
The closest is probably the 2030 target date series with 60% equity allocation. We see that for the 10 and 15-year time horizon, target date funds and US balanced funds were roughly a match. What's interesting is that the global balanced funds category fared worse. This is not surprising given how non-US stocks underperformed the US equities. As for the risk-adjusted metrics, we have have here the Sharpe ratio. Again, target date funds and the US balanced funds were roughly a match. As you may know, Sharpe ratio is a risk-adjusted metric that uses volatility as a proxy for risk. I am not a big fan of this approach. Volatility is a very poor measure of risk, objectively speaking. If you would like to learn more about why that is, you can watch my video on this topic linked here.
Overall, it's not clear if one is better than the other based on what we just saw. I mean, after all, it's just a historical data. And if for some reason foreign stocks outperform US equities in the future, US balanced funds will be smoked. So I would say it's probably a draw or maybe inconclusive at its best. What do you think? Let me know in the comments. The next point of comparison is diversification. And here, target date funds probably provide a better deal for investors.
A typical balanced fund allocates less than 10% to foreign stocks. It has an even smaller allocation to foreign bonds. Conversely, target date funds have 30 to 35% of their portfolios in foreign equities. Of course, there are exceptions to this. As we saw, global balanced funds have a high exposure to foreign securities.
Having more exposure to foreign stocks, as we just saw, is not always a good thing. Who cares about diversification if foreign stocks are underperforming? If I had a crystal ball 10 years ago, I would ignore foreign stocks altogether and would just go all in on US equities. But still, the diversification is a benefit that many investors care about, and that is a big plus in favor of target date funds. Also, target date funds can give investors a slight edge over balanced funds with some allocation to other types of assets. These could include commodities, real estate investment trusts that are publicly traded, and even treasury inflation-protected securities. As for the last one, they provide protection against inflation, which is a plus too.
The final point of comparison is convenience. Target date funds allow investors to achieve the desired diversification without much work. These funds do that all in one place. What's more, their allocation shifts to bonds with time as retirement date approaches. You don't have to give it a second thought. This allows an investor to de-risk before retiring. Conversely, balanced funds keep their asset allocation fixed. For someone before or in retirement, balanced funds may be too risky.
Of course, even target date funds are not ideal. Their predetermined glide path for allocations may be too rigid for someone. Moreover, most of these funds they will converge on a 70% allocation to bonds and 30% allocation to stocks at the end of their term. And for instance, if I plan to work in retirement, perhaps I can afford a higher allocation to stocks than what it offers me, which is 30%. One solution to this problem is to buy a target date funds with a later date.
Another problem with target date funds is their rapid shift to bonds before retirement. There was some theoretical and empirical research done on this. They show that this glide path is suboptimal. Let's suppose an investor wants to maximize the size of his retirement portfolio. Then allocation to stocks should become higher, not lower, before retiring. The reason is somewhat peculiar. When you're young, your portfolio size is small, so even having almost everything in stocks does not elevate your assets a whole lot. Conversely, 10 or 20 years before retiring, the portfolio size is becoming large. Thus, having higher equity exposure can earn much more in absolute dollar returns.
Of course, this is all fine and dandy. But what if the stock returns turn out to be horrendous during the last 10 years before retirement? I mean, this is possible, and that can wipe out all the prior year gains, which is the worst outcome for someone nearing his retirement. So we can theorize about probabilities of this happening based on historical data, but at the end of the day, it all doesn't matter if I don't have cash to pay my bills. What's more, as people approach retirement, they care less about maximizing their returns. Instead, they become very risk-averse and focus on capital preservation. And that, ladies and gentlemen, is what explains the great popularity of target date funds these days.
With that said, balanced funds can be an option for a certain group of investors. In the long term, balanced funds can be that Goldilocks solution. It could work for an investor who dislikes volatility from stocks, but needs fixed income returns for stability. You also must be okay with balanced funds fixed allocations. Otherwise, this becomes a real problem when the retirement date approaches.
Taking all things into account, it seems that target date funds provide a better option for retirement portfolios. While they're not ideal, they come at a lower cost and offer better diversification benefits compared to balanced funds. Also, they're easy to use. With their automated glide path, target date funds simplify investment decision making to the minimum. And that is it for this video, guys. I hope you learned something new today. If you did, please give it a like and subscribe to my channel for more content on investing. Thank you for watching.